Welcome back, everybody, to Magnolia on Money, where we discuss everything financial from the economy to retirement. I'm Ed Cox with Magnolia Wealth. And today, I'm doing two shows this week. One was my regular show, and I told you that once the Fed spoke and came out with what they were going to do, that I would come back to you guys with a kind of an update on that and then discuss the market real quick. So the Fed increased rates 0.75%. And right in kind of line with what most people thought it would be. So it wasn't a huge shock. Powell made a few statements that I thought are have been in line with what he said, that the Fed is not backing down. We're going to continue on this path until we get inflation down to that 2 to 3% range. A lot of people are starting talking about the pain that's going to happen with this. Okay, and so they've made some mention of that recently, and even Powell said that look, if you're in the situation we're in, with rates at the all-time low, basically zero, and we're trying to get rates back to a normalized range. Number one, number two, we have rampant inflation. Fixing that problem was always going to cause pain. People were saying that, hey, well, I think they can land this plane without, getting into a recession. Well, we're in a recession. It may be short and it may come and go depending on what this next quarter GDP shows up. But, there's going to be a little bit of turbulence as they get this inflation down. And why is that? We're having the issue in the economy because there was too much money thrown in the economy at one time, number one. Number two, we have major issues with supply chains. So it's kind of this perfect storm that's created this inflationary problem. But their way out of that is raising rates. And that puts a lot of pressure on borrowing. It tightens money supply, so money's not as readily available for people to spend. And that's going to filter down into the economy and affect corporations, businesses all across the country. And so when that starts to happen, it will trickle down into reduce the inflationary pressure. Okay, so I'm going to flip over my screen real quick and show you this year what has happened. So the Fed rate hikes so far this year, starting March 17th, they started with a quarter point, then went to a half in May, and then it's been 3 quarters since then. Here's the Fed funds rate. You can see where it was in March and where we are today. So huge jumps. Where's this making its biggest change or effect, excuse me? Really in the real estate market. You've seen mortgage rates go from 3%, even under 3% on a 30-year mortgage. Now we're above 6%. And so that directly affects those mortgage rates. Car loans, not as much. It does affect them, but not as much as it would on a home loan. You're seeing credit cards get affected and things like that. But the main gist is they are shrinking or tightening money supply, so it's harder to get money and it's more expensive to use money and borrow. Okay. Let's look at what the market's done. So year to date, this is just a snapshot. Year to date, we started up here. We are down 21.16 when I snapped this earlier this morning, I think is when it was. So we're down 21.16%. That's the S&P 500. I've told clients, this year already that if you start naming all the things that are the headwind we're fighting against, we have supply chain problems. We have the war with Russia and Ukraine. You have the Fed raising rates, trying to tamp inflation. You have we could sit here and go on and on with all the things that are happening all at once. For us to be down in the S&P 500 only 21% is kind of shocking. I think we could definitely be down a lot more to this point. So that the fact that it's holding on where it is, companies are still, showing decent profit and some growth is a testament of how strong the economy was before all this hit us. So, but this is year to date. Okay, so that's where we are. And then I wanted to show you, because it's always good to look at perspective of where we are. This is the 2-year returns. I just plugged in the 2-year and see where we are. That's September the 21st, 2020 through September 21st, 2022. We're up 13.29%. Not bad for a 2-year market return. Okay, with what all we've been through. So when you really step back and look, things are not as bad as they may appear. Yes, it's been a rough year. Yes, we got some more rough patches ahead. But the last 2 years, the market, from 2 years ago to today, the market is up 13.29%. That is not a bad 2-year return when you considered what we've been through. So it's always good to put things into perspective, step back, analyze where we are, and then go from there. I hope this has helped. Maybe it's relieved some of the anxiety. Hopefully it didn't add to it. But I told you guys that I would come back with a little update on it, and I hope this has helped y'all. Y'all have a great week. God bless, and we'll talk to you next week. Take care. Bye-bye.